guys, welcome to the Treasury Update Podcast Coffee Break Sessions, the show where we cover foundational Treasury topics and questions in about the same amount of time it takes you to drink your coffee. Today, I am joined again with Stephanie Villatoro, Senior Consultant here at Strategic Treasurer. Welcome back, Stephanie.
Thank you, Alexa. Glad to be here today.
Yeah, so this week we're going to finish up our new mini-series for the Coffee Break Sessions on global Treasury topics. And today we're going to cover how to address global financial risk. So to start this off, do you mind giving us just a quick overview, kind of to recap what we covered last time on what global financial risk is, Stephanie?
Yes, global financial risk can come in various areas, but it's anything from foreign currency to the country that can impact your financial situation within an area or a country or a region of the world. It could be foreign currency, it can be country risk, it could be counterparty risk. So any kind of area there that can impact you from that standpoint.
To kind of dive into what today's session is going to cover, what are some of the just typical ways that we can address this global financial risk? I don't know if you want to go through high level what some of the ways are, and then we can dig deeper into each of those ways, or how you want to.
Certainly, there are a few areas. You know, you have hedging is one of those. Looking at your commodity risk as well, or FX within hedging. Those are one area. Looking at where you lie around the world, looking at your counterparties and assessing that as well. So those are some different areas you would look at.
Let's maybe dive into the hedging. I know hedging, for me, at least when I hear that word, it's always been a little bit intimidating. So let's start there.
You're not the only one, and many boards would agree with you that it's one of those things that sometimes they choose to hedge or not hedge because they think they're being conservative, and it's actually the opposite. When you choose not to hedge your position when it comes to foreign exchange, for example, and you're not hedging, then you're actually taking on more risk because you're not neutralizing your risk. So you're more volatile in the FX world if you do not hedge, if you have a lot of exposures. If you don't have exposures, then not hedging is not a necessity there. And there's different ways you can hedge. Hedging programs are probably the one thing that is more of the thing that makes you just your head spin of like, what is a hedging program? What do I do? But when you're looking at hedging, it's not always a program like a hedging program that's very complex. It could be very simple as to currency matching, making sure you're offsetting natural hedges. And that can be done without an official hedging program to neutralize your risk as well. But the overall goal of a hedging program is really just to minimize your exposures, whether it's transaction or translation with foreign currency, for example. When you do get into hedging, after you look at what you have currency-wise worldwide, aggregate your positions, look at what natural hedges you have, then you can see your true exposure. From that exposure standpoint, you can move into a hedging program, whether that's locking in options and forwards, locking in rates for transactions. There's different things you can do there. To set up a hedging program, once you've analyzed your risk and things and determined that you do need one, that might take a little more analytics. Putting in, pre-trade analytics. What are my exposures? What do I need to do? Actually putting into those trades into action. And then your post-trade analytics, so your pre and post-trade. And then you have to look at hedge accounting, mark-to-market, making those decisions, looking at your VAR analysis, which is value at risk, helps you judge your exposures and stuff in the market. So that's FX. The same thing can go with commodity as well.
And before we jump down into the commodity section, I know you said natural hedge, and I just maybe wanted to ask what you meant by that, or what a natural hedge is, just in case anybody listening isn't 100% clear on what that is.
A natural hedge are two opposing currencies, so two currencies that move in the market that offset each other from an exposure standpoint. And there's many natural hedges out there, but they're natural if you hold two currencies that offset one another from a risk standpoint. One goes up and one goes down, then you're offsetting and neutralizing your risk.
Okay. You said there's also the commodity piece. I don't know if you want to just quickly touch on that.
I can quickly touch on commodities. Commodities are the same as foreign currency hedges, but you're actually dealing with physical commodities, whether it's coffee or sugar or oil. Those are commodities, and you have to purchase those if you have a business that uses those or consumes those for their products. Whether it's airlines, whether it's, Nestle Toll House cookies, whatever it might be, that you have a commodity that you buy in bulk. You have an exposure to the purchase price of that commodity. So you want to minimize your risk there as well. This is where hedging instruments of forwards and options to buy at different price points to neutralize your risk there, or at least be able to forecast it much better. So you have a forward in place for 12 months, or maybe an option to buy in 12 months at a particular price that you can exercise or not.
Okay, that makes sense. And when you said the commodity and buying things in price, I immediately thought of toilet paper, just with how the year of 2020's been. So I thought I'd mention that.
Yes, and during this 2020 with COVID, we not only saw toilet paper come off the market, but we saw the price of supplies for building material supplies astronomically go up, and the cost of homes actually went up as well to build because of COVID.
So then I think at the beginning, you also said that there was counterparty risk. So I don't know if you wanted to mention a little bit there too.
There's two different ways to look at counterparty risk. Counterparty risk is, most people think of who are my banking partners when you're looking at treasury, and what is my risk of doing business with a particular counterparty. You try to spread your risk. You have multiple banking partners. What if one of the things we see a lot of is the exiting of different services like lockbox services in the US, always having someone else to move those services to if your vendor, your bank decides to exit out of the business. That's a risk. That's a business risk. But what you don't think of is counterparty risk on the other side. Your suppliers, there's a risk involved there, as well as your customers. So you have risk with customers and risk with suppliers or vendors as well.
I believe we've covered everything that you touched on at the beginning, but is there anything else that we should talk about as far as how to address global financial risk?
Global financial risk. So even if you're a U.S. customer, as I said, I think on one of the previous podcasts, you may be U.S. based, but you may have outside of the country or global risk because of a supplier or a vendor. You don't have to be a global company to have global risk. That's one of the things. Different things that you need to look at is what are your political risks? Where are you in regions of the world? Is there a war brewing in the Middle East? Is there something happening that's going to impact your operations, or even maybe one of your vendors or suppliers or your customers having in different areas of the world? So you don't have to have that physical presence, but that does as well implicate potential risk in a different area. Keeping abreast in just the market. What are new risks in different areas? What regulations do you have to comply with? Also, how you assess. There's different ways to assess risk, whether it's share of wallet for your vendors or your banking partners. You can also do that with your customer base. What percentage of business do you have by customer? Looking at where your risk lies there. If you have a large percentage of your business with one client, what happens? What is the stress analysis there? What happens if that client leaves? That's another way of assessing your risk. Having good forecasts in your different regions of the world as well help you have that data to look at ways to assess your risks, whether it's commodity needs or FX.
Okay. Again, some of the different areas of global financial risk could be anything from foreign currencies or countries that are impacted, or counterparty risk. And like you just said, even if you're just a small domestic, shop, that you could still be impacted by that. And I think I really liked your example about the lumber and how that's really skyrocketed from just the global pandemic. And so even if you're working in construction locally, this business has really been impacted by that, and that's really their commodity pricing. And so different ways that we can address this global financial risk is via hedging, whether that's hedging the foreign currency or commodities. And there's a couple different ways to do that. And then just some of those other risks are counterparty risks. So that might be vendors, suppliers, or customers. and then just kind of keeping an eye on the marketplace from both a domestic and a global perspective, politically and just macroeconomic scale.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.